Hello, everyone. Welcome to Wall Street for Main Street podcast. My name is Mo, and today's guest is a returning guest. His name is David Morgan. He's the editor of the Morgan Report. David, thank you for coming back on. It's been a while.
It's been a while, Mo. Well, thanks for having me.
All right, I wanted to start off this podcast by talking about what's going on in the economy, and especially focus on the Federal Reserve because they have been in the news a lot, talking about the possibility of raising rate, even though it's going to be pretty minimal, has a lot of people a little concerned. I don't think it's a big deal. I don't think it's going to impact the market that much, but I just want to get your thoughts on it.
Well, I agree with you, but I thought the initial raise would not have much impact, and there certainly was an impact at that time frame. Whether you can point it all back to the interest rate increase or not, I'm not convinced. But nonetheless, the very minimal increase did take place in the markets. Certainly had a very, very weak start for 2016. Contrary to that, on the commodity side, silver's been one of the best performers in the entire commodity sector so far this year. So there is an inverse correlation between gold and the stock market. And silver and gold are correlated at about an 85% level. So if you just use some simple logic, you can say that silver as well as gold is inversely correlated to the stock market.
Now, if you look at the chart for the stock market, whether it's the Dow Jones or S&P 500, all the monetary artificial pop given by the Federal Reserve has lost some steam in the past couple of years. If you look at what happened in 2009 when it bottomed and started to go back up, and you look at the past couple of years, the market has gone sideways the past couple of years. Do you think the law of diminishing return is kicking in here, and the quantitative easing, the low interest rate is starting to lose some momentum in the economy and the market?
I do, and I'll add on to that. I mean, basically, when you get a sideways pattern like that, that's called an indecision pattern. That's what I like to call it. It's also a distribution pattern, which means that the pros are shoveling their gains onto someone else in order for them to actually, book the gain or take the gain or bank the gain. They have to sell their stock to somebody, and of course they want to sell it at a high price, and they got to sell a little bit over time because they sold their whole holdings at one time. That forced the price down immediately, which of course happens in the futures markets from time to time in the precious metals and other commodities. Regardless, back on track. So they have to distribute just like they accumulate. So they sell a little bit, sell a little more, sell a little more, sell a little more, and keep feeding their supply into the market. That's why it's called a distribution pattern, is because they're distributing their large holdings to the unsuspecting people that are touted daily on the mainstream financial channels that the stock's going to go up, hold for the long term, buy and hold, buy, hold, hold. And so they're distributing. So right now, we're, as you stated, and I'll, reemphasize, is basically that pattern is near exhaustion. The pros are pretty much done. The public and some of the less savvy, let's say, money managers, et cetera. Some of these people have to hold a certain amount of stocks. I mean, their mandate isn't that they can, move in and out at will. Some can, some can't. Depends on, how it's organized, who it is, if it's a pension fund, if it's a money management fund, if it's a mutual fund. I mean, there's a lot of different situations where certain entities can do certain things and other entities that are in the market cannot. Regardless of all of that, I think the stock market is overvalued by any metric you care to use. There's always exceptions. There's always certain stocks or certain companies or certain good ideas. Those are not what I'm referring to. I'm referring in general terms that the general stock market is overvalued by any metric you care to use.
Yeah, if you look at the PE ratios for a lot of these industries, they are above what they used to be before the 2008 financial crisis. So the bubble is bigger than what it was before.
Absolutely, and nothing's been done to solve it. In fact, what caused the problem has been added to. I mean, the basic cause of the problem, as we both know and said too often, but it's debt that cannot be repaid. So these main bankers have added to the debt to more people that can't pay it back. In fact, put them in a situation that's even worse. So you've got bond bubble on both the sovereign debt side, meaning nation states, and on the corporate side. Whereas corporations may look good and they may have a lot of assets. They may have a lot of inventory. They may own buildings. They may own real estate. But if you check their debt to equity ratio, some are in good shape. I'm not trying to paint an inaccurate picture here, but a very large percentage of them are over indebted, and to raise money, of course, they float a bond, and they promise to pay a certain interest rate over a certain period of time. And in order to do that, they have to be a going concern. And a lot of these, if you really examine them, where they are in a free cash flow basis, what they really net out of their business, are they able to service the debt and service it in a sufficient manner? Will they be able to pay off that debt in a reasonable amount of time? The answer, unfortunately, is they are not. If you look at the fracking industry as a whole, that's a prime example of where most of these companies, with almost no exceptions, there's just a couple, are unable to really service the debt that they have encumbered on themselves to, frack and get oil and particularly natural gas out of these certain areas in the world. Primarily, it's done in the U.S. right now. It's done in other places, of course. So I'm just adding again on to what you said that if you take an industry by industry case, we have a very big contraction going on in several industries, and this is the real case scenario. This is the reality of the situation, regardless of those that state that anyone says the economy is not strong as peddling fiction. The truth is that the economies globally are contracting.
Yeah, and I read somewhere that the Federal Reserve would have to do a $4 trillion QE just to prevent a potential economic shock in the economy. So that's a little under their balance sheet, but that's a lot of money printing that they have to do just to prop up the market compared to the amount of money they had to print at the beginning of 2009 just to pop up the asset.
Exactly. I mean, the problem, there's so many, but I mean, really, you can make it simple, is the exponential function, compounding effect. That's why the Fed really can't raise interest rates very high, or what we consider reasonable in my lifetime when, I was your age. I mean, 5%, 6%, 7% was considered, pretty fair interest rate. I mean, if you had a mortgage at, say, 7.5%, you actually had a fairly decent rate mortgage. But those days are long gone. And for the Fed to see an interest rate at that level, the ability for them to service, it wouldn't be the Fed, but if the Fed had the rates at that rate, or the Reserve, I'll slow down, I'm getting excited. If the interest rate on the long bond was in the 5 to 7% range, the people that owed that debt, in other words, that had to service that debt, which is the U.S. citizenry, the federal government wouldn't be able to service the debt. They can't now. They already have to borrow to make up the difference. But it would be so astronomical because of the compounding effect. In other words, the interest rate at that level would really turn the markets further upside down. And of course, that's unlikely to happen. It could happen. I wouldn't rule it out, because as the bond market breaks, interest rates will be forced up, and the Fed won't be able to do much about it. So that, where do they go? When do they get there? That's not determinable. But what is determinable is that no bubble goes on forever, and the debt bubble continues to grow as we're speaking. And I believe strongly that it cannot go on a whole lot longer.
Is there anything else that the Federal Reserve can do to jump out the economy? They've been talked about doing negative interest rates. Japan had done that recently. It doesn't seem to be working very well. Do you think that's going to happen here down the road?
It could. There really isn't much else the Fed can do. I mean, they can monkey with interest rates and their monetary policy, and they can jawbone a lot, which they're very good at, pretending they're going to raise rates, and then, we'll have to see more data, and then, we're going to raise rates, and then we'll see more data. So very good at rhetoric or jawboning and trying to, quell the markets or ebb and flow them with what they say. But as far as, what could be done, I mean, basically, you could go back from the government side, which is not the Fed, and you could create some make-work projects, and some could actually be a benefit to, the general populace. I mean, if you go back to what was done in the 30s, and I'm not a big proponent of FDR, I don't want any of my Austrian friends jumping all over me. I'm not necessarily recommending this. You just asked the question, I'm going to answer it. You could start something like a CCC course or something like that, where a lot of the infrastructure that's been broken down gets repaired, and you start paying off, $15 an hour for anybody who's able-bodied that wants to sign up and have work. I mean, the labor participation rate, as I'm sure you've talked about many times before on your shows, is at a low. I mean, there are a lot of people that really want to work that can't find a decent paying job or can't find a job at all, or all that can find is a part-time job. And so, there's a lot of there's economic activity that could be implemented. Of course, I am, much more free market oriented than the government dictating we're going to, do this, we're going to do that, we're going to, do these, what I call make work projects. But that could happen. I don't think it will. I think that we're so far gone at this point in time that the only way to really clear the markets and get a solid foundation again is to let all the misallocation of capital collapse, and for the market to determine, what the true price of everything is, which means, a reset to what, this business is worth, a reset to what a commodity is worth, a reset to what labor is worth, and on. And this would be a very painful process, because the longer it gets distorted, the more distortion takes place. Again, going back to the exponential function, it's gotten so out of control that now, if you go back to what was normal interest rates in my lifetime, I'm not as old as the dinosaurs. I'm still, it's one lifetime. That normal interest rates, what we would consider normal interest rates when, again, I was, in my 30s, would be intolerable for the markets to stand in the debt situation. So this means, again, that we are in a situation that very few people are really cognizant of. I mean, channels like yours, people listen to podcasts like yours and others. I mean, they're very aware of it. And in fact, they're probably very concerned about it. But what they may or may not realize is that they are in the very, very small minority of people that really understand what, a debt market is, what a bond means, what the interest rate effect is on a debt instrument, how overspent we are, and, on all these things are connected. So, the shows are great and I love doing them, but I wish there was a way to get more involvement by people that either don't have the time or the interest to understand really where we are, because the more people that really are educated about the situation, the more that they are more likely to take some action, which could be some very simple actions that could help them, let's say, weather the storm.
Yeah, and we have a lot of growth in our podcast, and we have our audience is a lot bigger than when we started interviewing you. But I agree, we're a minority, and unfortunately, most people get their news from the Huffington Post and mainstream media, and if you look at the election and see all the stuff they're talking about and all the where the focus is, there's no focus on the overspending and the debt problem and the bubble and the asset market, like the stock market, and real estate, depending on where you're living, is also overbought. So yeah, we're waking people up, but unfortunately not fast enough. And I think the Federal Reserve must be on the edge of their seats right now, because they're out of tools to use to try to prop up the market. And I don't know how they can justify to the American people that they need to bail out the banks again if there's another economic collapse. I mean, just look at what happened in the news with Wells Fargo, that they laid off or fired over 5,000 people, and they got a slap in the wrist for, stealing money from people's account to, meet their sales target. And no one got fired, and nobody went to jail. And people are outraged right now. So I don't know how they're going to justify that they're going to have to bail out the big banks again.
Well, I don't think they have to justify it. I mean, the rule of law has decayed to such a point that that it does anger people, but they haven't taken to the streets yet, and they certainly may. It's really sad what's going on. I mean, if you look at the way the situation was set up, I should say the way the laws are set up, same rules, laws, and accountability for everyone. Same rules, same laws, same accountability for everyone that is in that jurisdiction, which means if you perjure yourself and you're a president or a presidential candidate or a member of the cabinet or in Congress, or you just lay bricks for a living, you still have the same rules, laws, and accountability, and everyone's treated the same. That's what the whole all men are created equal is all about. And without going into the black dilemma at that time in history, which is unfortunate, and I don't have time to go into it, but the whole idea being that we're all equal. And unfortunately, that's not true anymore. And it's not only true with certain political people, it's not true with the banking elite, even the bank workers. And it's not true for certain unions. And it's not, so there's all these special cases. So the rule of law has absolutely lost meaning in all ways, shapes, and forms. And this is starting to wake up some people that have, quote unquote, played by the rules their whole life and have, their whole retirement nest egg in an IRA. And now they're starting to wake up and say, if all my savings for my, golden years are in my IRA account, what's to prevent the government from saying, and this is going to happen, I predict, that, that IRA you have, well, 50% of it now has to be invested in U.S. long-term bonds. You have to buy 10-year treasuries. And you don't have a say in it. They just vote. Congress says, oh, yeah, we'll do that. The bankers told us to do that. And all of a sudden, your $200,000 IRA, $100,000 of it gets swapped over and you just bought 10-year notes. And you had no say in it whatsoever. And you think that's extreme, but it's not. In fact, it's not that extreme relative to what's been going on. The other one that concerns me a great deal, Mo, is the bail-in provision. Because with the Dodd-Frank situation, which was passed in the law, it basically says there cannot be a bailout anymore. No more bailouts. Well, if there are no more bailouts, what does that leave? Well, that leaves bail-ins. And so, people that listen to shows like this, I do not like being labeled, a doomer or a doom-gloomer or any of that. I mean, I've been looking at this thing probably as long as almost anybody living. I'm not that old. I just started very young. But, there's still Jim Sinclair. Jim's probably 10 years my senior. Regardless of age, the point I'm making is I never thought it would get this distorted, where the rule of law breaks down entirely, where the executive branch can just flick the pen all day long and create stuff out of thin air that has no constitutional validity, and on it goes. And that's the real world that we're living in. So I want people to wake up and think ahead of where we are and where we are going and what could take place, and think about it. If a bail-in is a distinct possibility, then you might check how much you have in your banking account. If an IRA could be in jeopardy, you might look at means to at least put some of it in, let's say, a precious metals holdings rather than in, say, the stock or bond market.
Yeah, and I'm very wary of retirement accounts because once you open up an IRA account or 401k and you put money into it, you're subject to government rules and regulation, and I don't like that. So, I mean, if I want my money, I should withdraw anytime I want and not have to worry about consequences. So, with that being said, is it possible that the Dow could hit 20,000 before the end of the year? I'm looking at the chart, and there's a lot of resistance at around the 18,600 mark, and I'm having trouble breaking that resistance. I just want to get your thoughts. With everything that we just said, is it possible that it could go up even higher before we could see another contraction in the stock market?
Well, my age, and making as many calls and forecasts as I have, I always want to be right. Of course, no one can be 100% of the time. Is it possible? Yes. Is it probable? No. Again, the distribution pattern. The only way to get a market to move higher with substance is to get new buyers into the market. And there aren't a bunch of new buyers out there. So that's a logic issue. As I said, the supply has been distributed to the weak hands. The strong hands have been distributing their stocks at high prices to weak hands for the last couple of years, as you pointed out. So now, for it to get to 20,000, it could. I mean, if we go back to what you said earlier on, if we get another financial moment, let's call it, and the Fed comes to the rescue with, $4 trillion in QE, where's that money going to go? Well, a heck of a lot of it would end up in the stock market. So in that case, would you see 20,000? Sure, you'd see 20,000 pretty easy. But outside of something like that, in the current status quo, with no injections of new capital, it'd be very difficult to see it go to that level.
It could happen. I've seen a lot of people make that prediction that it could hit 20,000 before the end of the year, so it'll be interesting. I mean, hitting 20,000 does not mean anything in terms of how good the economy is doing, because it's not much quality jobs out there, and we're starting to see contraction actually in the restaurant industry, and that's where all the job growth is coming from right now. Is the restaurant industry, and we're already seeing some negative growth there. So it's going to be interesting to see what happens down the road. And with the 2016 election around the corner, I'm sure the Federal Reserve is doing everything it can to keep the stock market and the economy stable until I think they want a Democrat in office. So I guess until Hillary Clinton wins the election, if she can stay alive before the election comes around.
Yeah.
I want to talk about everybody's favorite asset, which is gold and silver, before I let you go. So gold and silver had a great year this year in 2016 after a couple of years of consolidation and downturn and a lot of pain and frustration. And the stock did very well this year as well. Some of them up 100 to 200% this year. So I just want to get your thought. What contributed to the rise of the gold and silver prices this year?
Oh boy, that's a great question.
Yeah.
It's very hard to know what the intent is. I mean, the old adage that the cure for low prices is low prices. I think that was part of it. It finally had bottomed. People were finally tired of it. And I think a lot of people that are, think ahead of the curve, looked at where the stock market was, looked at where the gold price was, know that they're inversely correlated. And again, that smart money that was distributing their supply into the weak hands had money to spend. And where were they going to spend it? Well, if they're, now negative on the stock market, or at least taking profits, where are they going to put those profits? Some of that, filtered in the gold market. And then you see these two banking entities, one out of Switzerland and one I think was Norway, that are buying, precious metals mining shares. So there's just been a turn in psychology. Again, what's the intent and why is very difficult to narrow down. There's a multitude of reasons. And a lot of it, after a certain point, is momentum. It's people that watch what markets are moving and what the volumes are, and then there's algorithms. There's, mathematical equations that are used by trading platforms and say, oh, silver's moving, we're going to get on silver. Oh, it's moving more, we'll get some more. And that type of thing. So it kind of feeds on itself. In fact, the rally, I knew it'd rally in through January, February, and then I saw the momentum myself, so I thought it'd probably go into April. And then I saw it in April, I said, wow, this is going to probably keep going. And I actually thought there would be, more of a substantive correction or, contra movement before now. I mean, now we've seen some kind of sell-off, and whether it's got further to go or not, I've got my ideas about, and I put that out to the website members. But as far as where we are long term, we reestablished the bull market. I think it's got quite some time to go, meaning probably 3 to 5 years, and the upside potential is very, very big. But that doesn't mean that the bull won't shake off a lot of players along the way up, because that's the function of the bull market. So there will be some scary corrections along the way, but nonetheless, the asset class that's, negatively correlated to the stock market has started to rise. And so that's another clue or cue that the stock market, generally speaking, is not the place to be.
I think a lot of people were surprised that gold and silver continued to go up during the summer because that's usually a time where gold and silver doesn't do that much up until August and September. Then it starts to rise again during the bull market phase. But then we had the Brexit, and that sort of jump-started the prices in gold and silver. So I think
that's true. I think that's true, though, that Brexit did have something to do with it. But the seasonalities for the metals have really been off the last probably 4 years. We used to see almost the seasonality for silver and gold, and even the other whites, platinum, palladium. I mean, it was really strong going into December, January. I mean, you could bet the farm almost. And what had happened several years ago, like 4 or 5, I'd have to look, you started getting the lowest print price, the low of the year, on the last trading day of the year. And that's very easy to accomplish because most traders have left and they're long on holiday. They're not trading the markets at all. So the very thin market is very easy to move up or down. And year after year after year, I think 3 in a row, we had the lowest print of the year in the precious metals on the last trading day of the year. And that's very, very different than the seasonality that had taken place for decades. So then the summer, I mean, usually the low for gold is in August. That's very provable, but usually doesn't mean every time. And this year we had a pretty strong August. We've had, some falling back in September. And, so the seasonalities, again, are not as important as they were, let's say, a few years back. Will they reestablish a new seasonality and go back to the ones that we've seen before? I kind of doubt it.
Right. And then we look at the gold and silver stock, and that's done very well this year, outperforming the hard asset. A lot of our favorites are up 100, 200%. Do you think they've gotten a little ahead of themselves this year? Could you see a sharp correction sometime in the near future before it starts to go on its way upward?
Well, some individual stocks have had a pretty sharp correction, and yes, we were warning our website members that the stocks had priced silver at $25 an ounce, and yet the high had been like $20.80 an ounce. So we were letting our members know that, you wanted to be careful. You certainly wouldn't want to buy there. You could protect yourself with puts or write it out or whatever. But I made several videos for the website members talking about that point, and some decided to take profits. Now, I never want anyone out of the market all the way. I think this market's way too important, but that doesn't mean you can't take partial profits. And that's a good psychology, too, because when you take a profit on a stock that's up 300%, I mean, if you look what AG did, I mean, it was phenomenal, but it also sold off rather sharply. And we know that, not everyone that subscribes to the Morgan Report follows the exact model that we use. In fact, probably very few follow the exact model. They find their favorites and they buy them and they get lucky and they have like the best 3 that we have or whatever. And anyway, the point being that, it's an individual choice. I mean, it's a service. It's our research. It's our blood, sweat, and tears. But nonetheless, we can't trade for these people. But we can give strong indications of, where we think the market's going to go on a fairly short-term basis and a long-term basis. And depending on their personality and what their profit margins are and their risk tolerances are, we can make suggestions. And several did make, or I should say did take partial profits and are pretty happy with it.
Do you play with the futures market, or do you just?
I do it all. I do everything. Yes, I'm one of the few, and I hope I don't sound like I'm bragging because I don't mean to. But there aren't many that can invest and trade. It's 2 different psychologies. Investor usually is to buy the very best of the best, whatever industry they're in, buy them relatively cheap, and hold for the long term, and that's how you really make big money. A trader most traders overtrade and don't know what the hell they're doing. And they have even a trading program or whatever. I've learned after, several decades, after about 2 decades of how to really do it to a high level of accuracy. Doesn't mean I win every trade, but it means I hardly ever lose much. And I teach that as an educational service at the market report because they look over my shoulder and I showed the setup, and then the market has to perform in a certain way for them to enter the trade. And that's exactly how I do it myself.
Yeah, it requires a lot of capital, and you have to stay on top of it almost daily because it's like because it requires a lot of capital. It's almost like you're going to the casino because you could win a lot in a short amount of time, or you could lose a lot in a short amount of time.
Well, if you look back at, let's say, one of the best trades I ever made in the silver market was in 2011. And
right.
Maybe it went back to 2010. And there had been a channel formation and distribution, and actually it was an accumulation pattern where big money was accumulating silver. And so once it got above 19, it had to do this, and this above 19, and then we're in. And it did, and we got in. And then it went all the way up to 26. And so that was a $7 move. It's, a $5,000 contract. That's $35,000 per contract. Not a bad day's work, right? And so I sold at 26. And then QE2 was announced. And I got right back in at 26. I basically got in where I got out just a few days later. And then I rode it from 26 to 48. So you could do the math on that. And so that's a position trade. I could trade like 2 times a year or 3 times a year or 5 times a year and be perfectly content. But it took me a long time to get that kind of an attitude. Most people, once they trade, especially if they make 2 or 3 trades and win 2 of them right away, they think it's easy and then they get this, what I call over trading mentality. The people that are professionals, I consider myself one, but the real professionals that are in and out of the market every day, they're either on the floor of the exchange itself or they're off floor. They've got a computer system right there, or they're trading for some, some entity or some, pool fund or something like that. But most people lose trading, so it's not for everybody. But the way that I've established my the trading to match my personality. Day trading, forget it. I'd blow everybody. I cannot do it. I know I can't do it. So why do I bother? I don't bother day trading at all. What I do is what I call position trades. Any trade that I get in, I really want that baby to go a minimum of 6 weeks and hopefully 6 months. And that's where big monies are made in the futures markets. But those type of setups don't come along very often, but they do come along. In fact, I think there's going to be another one in the silver market that may do as well as or better than the one that we did in 2010 and 11. Now, whether or not I can get that close to the exact top, I doubt it. But, you don't have to get the exact top, especially when you're leveraged.
So let's go and talk about the capital market for the gold and silver miners. Has it improved compared to last year when price of gold was around $1,000 and silver was around $15? Or is it a little too early for the capital market to start to catch on and improve for that sector? Well,
the purses are starting to open up. Capital markets have improved. Money is flowing, but the purses are open. They're not full open, as an analogy. So yes, good projects with good management that are ready to go. They're finding funds fairly easy. Ones that are a little more capital intensive or need a little more work, that need a PEA or, they need, are not finding capital, maybe easily, but it's available. So yeah, it's, as the market improves, the capital flows improve. And so, that, it's just par for the course.
I don't know if you heard, but I'm sure you have, but the Swiss Central Bank has started to buy gold and silver stock. What is your take on that? Why do you think they're getting into that market right now?
Boy, I'll tell you, there's several ways to look at it. One is that they can't buy bullion very easily, so they're buying the next best thing. The other one, which I don't know, is just a bit of a wild guess, is maybe their jurisdiction or their mandate, I should say, prohibits them from buying bullion, which I doubt, but it's possible. There's a lot of people that manage money that can't buy commodities. That's why the ETFs were created to a large extent, because these guys wanted to buy silver and they wanted to buy gold, but they couldn't. So the ETFs were created, and now they're buying a stock, but the stock is really a link to gold and silver. So it could be that.
That's not a bad move either. I mean, buying gold and silver stock from the central bank is better than what the Federal Reserve is buying, which is bond, Treasury bond.
Well, absolutely. I mean, I'm favorable to, I've been consistent. I try to be consistent all the way up and all the way down. And that means that I've always said that you should start a precious metals portfolio with real metal. But would you rather own the chicken that lays the golden egg, or would you rather buy a golden egg? And I would rather own a chicken that lays a golden egg than buy one golden egg from the chicken. So when you buy gold, you're buying a golden egg. But when you buy the right mining company, you're buying the chicken that lays the golden egg. And I like that. And that's why I do what I do in the mining sector. Now, there's people out there that say you should do bullion only. And if that's your belief, then that's fine. Do that. But if you are really have an investor mentality and know what you're doing in this market, ask yourself the question: you want to buy a golden egg, or do you want to own a chicken that lays the golden eggs?
And yep, that's a good way to look at it. So, well, thank you for your time. I appreciate it.
Well, Mo, I just want to thank you for having this interview with me. It's always a pleasure to speak with you. And I just want to point out that for anyone listening to this podcast, either recent or later on, please go to themorganreport.com. I spent a great deal of time and energy to put together a free report for everybody called Riches and Resources. And all I need is a first name and a valid email address. In that Riches and Resources report, I'm going to answer two of the biggest questions that I get constantly. That is, where are we in the economic cycle? And this is a movie that you will get for free that you can download and watch. You can watch it in any format you want. iPad, on your phone, you can watch it on your TV. And it's called The Four Horsemen film. That's free. There's a link for that. And this is a good one also if you're very tuned in to what's going on in the global economy. You can watch this movie and send it on to your friends or your family or your brother-in-law that doesn't believe what's happening or wants proof or whatever. Also in that movie, there's some solutions at the end of the movie. On top of that, the question I get asked even more than, what's the economic cycle look like is, what's it going to look like for us? What's it going to look like for me? What does it mean? And that is a second movie that I have in the Riches and Resources report. And it's called The Empty ATM. And this is a documentary film on the Argentine financial crisis of 2000-2001. And this isn't what is it going to look like in somebody's imagination. This is a documentary film of what actually took place. There was a bail-in of sorts, which means that if you had $20,000 in the bank, it stayed in the bank. However, you couldn't access it. That's why they call it the empty ATM. You're only allowed to access something like 200 pesos on a weekly basis. So you couldn't make your house payment. You couldn't make your car payment. You basically had maybe enough to eat. And the bank kept saying, well, your money's here. You just can't access it except at this very low rate of 200 pesos a week. And then, of course, they did a devaluation while your money was locked in the bank. So that's what happened. And this documentary, I think, is something that everyone should watch, with the idea being, will it happen here? Could it happen here? And I'll leave that question open for yourself to determine whether you think that could take place again in another country. But this is something that is, a great answer to that question, because it's not my idea of what could happen or someone else's idea. This is reality. This is an actual documentary.
Okay, and that's a very interesting documentary. And where can they find it again?
Yeah, just go to themorganreport.com. On the right-hand side, all I need is a first name and an email address. You verify that. We'll get to the report. It's 11 pages long. I wrote every word of it with everybody in mind, trying to do as much good or be of maximum benefit for everybody that cares about their monetary situation, which is basically everybody on the planet. I mean, even the extreme poor usually worry about their monetary situation. This is a global crisis, and that's why I looked at this from a global perspective, and I picked a couple of films that I think would really, really help people. And most people enjoy watching films, so that's just part of the report. There's another part if you want to be a silver stacker. You can do that quite easily. It's a program that I know the founders of, and they have a very nice situation, and you can stack silver for, I think, as low as $100 a month, and It's a pretty good way to go.